Good morning and welcome to the RBG Holdings PLC Annual Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO John Divers. Good morning to you.
Good morning. Thank you, Alex, and good morning to everyone. And as Alex said, welcome to the annual results presentation for RBG Holdings PLC for 2023. So the people that are going to be talking to you today are myself, John Divers, I'm the CEO, and I'm joined today by my colleague Kevin Nair, who is the Chief Financial Officer. The reason that we put those two smiley faces and very brief bios on the screen is really to sort of start off the presentation, but also reiterate the point that we are a professional services business. We're now exclusively in legal services. But the backgrounds that myself and Kevin have are very, very different. And I think it adds an excellent and interesting dynamic to how we run and how we manage the business. We do very much run it as a business, not as a club. And the numbers that we get very much steer our behaviours. 2023, it was a year of huge change, a point of inflection for the group. In no particular chronological order, Marianne Ismail took over as chair when Keith Hamill resigned at last year's AGM in June. In January, I was appointed as interim CEO when Nikki left, and latterly as permanent CEO in March. On the previous slide, I just mentioned that we run it very much as a business, but we are acutely aware of the fact that the business we have is a people business. They say a business is nothing without its people, and that's never more true than when you're in professional services. And it's therefore wonderful that both Nick Davis and Tanya McLeod joined as exec directors in March of last year. Nick latterly being the managing partner of Memory Crystal, and Tanya McLeod, who was the managing partner of Rosenblatt. In June last year, our previous CFO, Suzanne Drakeford-Lewis, went on sabbatical, and we appointed Kevin as interim CFO. Suzanne chose not to return after that sabbatical, and Kevin was clearly having so much fun, he decided to stay on and become permanent, which is great. And finally, as part of an overarching strategic review that the new management team had taken throughout the first few months of last year, Ian Rosenblatt, obviously the founder of Rosenblatt Solicitors, also happens to be our largest shareholder, joined the board to focus very much on strategic outlook and strategic growth into the future. In terms of our priorities, well, we wanted to focus our efforts really on building and rebuilding the core legal services business of the group. There were certain areas that we didn't feel were necessarily performing as we would like, or we were getting the most from the interaction between our lawyers and our systems. We had a lot of non-core activities that were made under the group in a previous guise, namely Convex and Lionfish. You'll hear more about those in subsequent slides, but we wanted very much to step away from that. Legal services has always been very much the dominant revenue generator within our group, and therefore the desire to both nurture that and grow is clear for all to see. We had a few inherited creditors that we wanted to clear down, and Kevin will go into far more detail in a few slides' time around how we've been cleaning up our balance sheet. Myself, the wider management team and the board all feel that the business is now far more well positioned to return to profitable growth, but also probably the most important part of that, which is cash generation. So just to pause for a moment, there are people on the call now who are probably very familiar with us. They've been on the journey with us for a few years, but there are also maybe some people who are new, don't know so much about RBG Holdings PLC, and maybe potential future investors. So just by way of a brief recap, this is what we looked like in April last year. Over on the left, RBG Legal Services Limited, very much a non-brand. It's a limited company and it sort of pays our wages and we bill people from it, but that's pretty much it. The client-facing, customer-facing face of the law is done through two brands, Rosenblatt and Memory Crystal. Rosenblatt, largely the contentious side of our offering, Memory Crystal, more transactional, non-contentious. Then we have Convex Capital, which is a boutique M&A advisory business. They find entrepreneurs who want to sell their business, they take them on, they try and maximise the value that those people get for their business. And also we had Lionfish Litigation Finance. For those people not familiar with the nuances of the law, you're not allowed to fund through another company within your group your own cases. So the idea behind Lionfish was very much to scale up on the litigation finance piece and allow us to invest in other cases elsewhere outside of Rosenblatt, which would have been the natural place for it. Moving forward 12 months, we've sold those non-core activities, which leaves us exclusively as a legal services provider based here in Fleet Street in London. We sold Lionfish in June of last year, and although it wasn't a 2023 event, in March of this year, we've disposed of Convex Capital.
So as John said, the plan here is to restore value for shareholders and other stakeholders within the business. How are we going to do that? Well, the first thing is focusing on the legal services business. The two sides of legal services, Rosenblatt and Memory Crystal, have each been operating for more than 30 years successfully. And so we need to focus our energies there. That's the principal point of our principal objective for the management team, is to do just that. And it's to grow it not just in terms of broad scale, but actually focusing on areas that we think will drive the best growth in margins for us. So we've looked at, we obviously have hired 7 partners in the past 9 months. Some of those work in existing areas, and John can get into more detail of this later, but a number of them work in complementary areas where we didn't have a presence previously, but we think they're good opportunities to grow and improve our margins. The next area is reducing the group's risk profile. As John just said, we divested both of our non-core activities, Lionfish and Convex Capital. The other thing is, we announced last summer that we're writing down the retained value of litigation assets on our balance sheet. Now, just to explain those for people who aren't familiar with it, a lot of our work, the vast majority of our work, we agree fees and a fee structure with our clients, and we bill them either at different points in a transaction or on a monthly basis. But there are occasions where clients want to get involved in a case, and it's almost always dispute resolution, where they don't have the funds to pay us. And we may be willing to consider an agreement whereby we bear some of the risk and some of the expense of going through that case, but we take a disproportionate amount of the success of that case if it is successful. And this is common across lots of different law firms. It's not anything unusual. Within RBG Holdings, there were a couple of historic cases that were quite large. And what happens with those cases when we take them on is our lawyer's time, we expense it as it's incurred, so we write it off immediately. But we then incur outside costs for counsel, professional witnesses, experts, things like that, which can be quite substantial. And historically, what the business has done is it would not expense those costs, but it would capitalize them on the balance sheet. Now, again, that's perfectly acceptable under IFRS, and lots of other firms do it. But what we found last summer was that we had several million pounds of these litigation assets on the balance sheet that didn't make sense from our perspective to keep them there, because we just weren't confident enough that we were going to be able to monetize those. So we took the view that we would write them off, and we announced that in our results in July last year. The other thing we're focusing on is reducing the group's debt. We can talk a bit later about the structure of the debt and the history of it, but as one of the various things we've said we will do, we suspended the dividend policy for the foreseeable future. We are no longer going to invest in conditional fee arrangements or damage-based agreements, which is what I just described a minute ago. So we're not going to do those where we have to bear all the cost up front because we don't think it's a prudent use of our cash. Now, what we might do is, if we find a case like that, there are outside funding firms that will come and effectively pay us to undertake that work. We may consider those sorts of projects, but not on the sort of scale that the business did previously, because we just think the risk is disproportionate to the reward for a business our size. The last area is to enter into dialogue with our landlords. So when we acquired Memory Crystal a few years ago, they had their own office building, and then Rosenblatt or RBG Holdings had its office building. And the expectation of management at that time was future growth, future acquisitions. So they renewed the lease on both buildings, which means right now what we've got is the whole business is currently operating in a building on Fleet Street of 20,000? 25,000 square feet on Fleet Street. We've then got a building with 18,000 square feet on St. Andrew Street, which is about 500 meters in that direction, which is currently standing empty. The combined cost of those two leases, in terms of the leases, in terms of the rates, in terms of the service charges, comes to about £4 million a year. And one of our big objectives is to try to shed as much of the property as we possibly can. And so we're looking at subleasing all or parts of both buildings. And it's obviously quite a tricky commercial real estate market out there. So we can't be absolutely sure that we will, achieve those objectives, but that is a very high priority for us. Yeah. So these are just some headline numbers for 2023. And to give it some context, if you've had a chance to read through the RNS that we put out this morning, you've got the group numbers, which are the consolidated numbers, but we're going to talk an awful lot about the underlying business. And that's really the legal services business that we're taking forward. Because in 2023, we still had the impact for slightly more than half of the year of Lionfish and for the whole year of Convex Capital. Those are treated in the financial statements as discontinued operations, and I'll probably shift back and forth a bit between the two. If you have any questions, please send them through and I can get into the detail a little later. But the group revenue was 41.4. Of that, 39.2 was legal services. The rest was Convex, with a tiny bit from Lionfish. But if we look at the underlying business, the continuing operations, the adjusted EBITDA for the year was 4.6 million, which is an EBITDA margin of 11.8%. Now, in a lot of industries, that would actually be quite a respectable EBITDA margin. But from our perspective, that's a bit of a fail. We know this business is capable of much better than that. And our medium-term target is to get to the mid to high 20s in terms of an EBITDA margin. And we'll start to make that journey this year. I don't think we'll get there the whole way, but we can see how we can get ourselves a good part of the way back up that ladder to where we ought to be. A couple other KPIs that we look at a lot: lockup, which is the combination of debtor days and WIP days, because again, as a legal services business, we may work on a project for quite some time before we can actually bill it. And so those two things effectively tell us what the cash cycle is from when we put in an hour's labor to when it turns into cash for us. 127 days is, from our perspective, pretty respectable. The comparable figures last year were 135. So a step in the right direction. We think there's scope to improve on that a bit. The other two big KPIs we focus on are utilization and realization. Utilization is how busy are our people. And this year it was 70%. Last year 76%. Our target is 75%. And the fact that we only ran at 70% last year tells us that, is reflective of the fact that revenue was lower than we would have wanted it to be, and our people weren't quite as busy. The realization is of the amount that we actually get invoiced out there, or the amount of work we do out there, how much of it do we recover in hard cash terms? Because frequently what happens is, particularly around the types of projects we do, where it is a fixed fee agreed with the client up front, we may run over the number of hours we projected because the project is too complex, and we end up writing off a bit of time. So 87% was what we reported for last year. 85% is what we target internally, but the prior year was 90%. So the flex between the utilization and the realization, if we can crank both of those numbers up a little bit, it has an immediate and substantial impact on the profitability of the business.
Okay, so coming back to who we now are, and the two brands that we have within RBG Legal Services Limited. First of those is Rosenblatt, founded in 1989 by Ian Rosenblatt. And Rosenblatt, sort of summing it up, it is complex, high value, high margin litigation. It's quite often multi-jurisdictional, cross-border, etc. And really, I suppose, if you want to sort of judge yourself, you look at who you're up against, and very, very frequently we do find ourselves sort of on the other side of the courtroom to some of the largest and most well-known London law firms. We are delighted that Rosenblatt was ranked in Tier 1 in the Legal 500 for commercial litigation mid-market for 24, a great accolade. And just expanding on Kevin's point of a moment ago, the thing about litigations is great for your cash flow because fees are calculated using chargeable hours. So lawyers who work 5 or 10 hours, we will bill 5 or 10 hours. And then at the end of the month, traditionally the client pays, and obviously then you go and work for another month. On the other side, we have Memory Crystal, founded even earlier in 1978 by John Memory and Peter Crystal. And Memory Crystal is far more of a non-contentious transactional business. We crudely split it into corporate and real estate. But there's far more to it than that in terms of it. Within corporate sits banking, sits tax, sits CIPT, employment, etc. And in real estate, we also have a litigation side and a construction side. The fees there, far more of a fee estimate, a quote. So obviously the reason for mentioning that and the nuance is to make sure that the job is correctly resourced at the right level, so we don't sort of burn through a load of WIP that we then sort of can't necessarily negotiate and agree and get paid by the client. If we look at the revenue and where it comes from, and the reason for this slide is to sort of highlight the synergies of the business. You can see there 42% from disputes, 38% from corporate, and 20% from real estate. But if you split those two out, you can see that it's not far off a sort of 50-50. It's actually 42% in terms of the sort of legacy Memory Crystal and the legacy Rosenblatt. It's not quite fair to split them that way because there are people from Rosenblatt who, when the acquisition happened almost 3 years ago, some Rosenblatt employees who were working in real estate or corporate picked up the Memory Crystal side of it, and vice versa. Some people in disputes in Memory Crystal sort of navigated across to the brand. As I say, it's brands, not companies. That is Rosenblatt. So moving on to the financials, now going to hand over to Kevin again.
So there's a bit of overlap with the previous highlight slide here, but as we said, the legal services business turned over 39.2. That's slightly down on the previous year, but the previous year was heavily impacted by one specific project where we were taken on by the administrator of a large financial institution, and that single project was responsible for 6 of the 44 million in the previous year. So if you try to take out the impact of that single client, what you find is it's a relatively static performance from year to year. Now, the reality is we want to see our people busier. The equity capital markets and the real estate markets have both been patchy over the past 18 to 24 months, as people will see, having read the newspapers. We're starting to see signs of those improving, and that'll have a major impact as to how we do over the course of the next 12 to 24 months. If we see a strong return in equity capital markets and real estate, the opportunity for us to outperform market expectations is there, but we need to see that recovery in those markets. Adjusted EBITDA, as I said, was $4.6 million. The actual accounting loss after tax was minus $11 million. And the big gap on that is the non-recurring cost, which we'll get into in a bit more detail. John said last year was a year of change and a year of inflection for us. And what we found was that there were a number of things within the business, either sitting on the balance sheet or activities that rolled over from previous periods that we had to clean up. And they had a very significant impact on us from an accounting perspective. Most of them are non-cash losses. Some of them definitely required cash at the time. But the vast majority of them are things that have now been completed, have now been cleaned up, and will not impact on the business going forward. Can you pop to the next slide, please? So looking at that, here's sort of a breakdown of the non-underlying items. Now, again, one of the things that people have seen is we had to restate the balance sheet for the end of 2022. Part of that was around some changes in accounting policies. Part of that was around some treatment of different assets that the accounting treatment was deemed inappropriate, and we agreed that it was inappropriate with our auditors, and so we've had to restate things. So if I go from the top to the bottom, the first item is almost a rounding error in comparison to the next three, and those all relate to the DBAs and the CFAs that we mentioned earlier, where previously they had been capitalized on the balance sheet, and we took the view that that was inappropriate, and we agreed with our auditors that the accounting treatment was inappropriate. So when we restated everything, what you see is that in 2022, there were one-off costs of basically $9 million specifically in relation to those assets. Now, the figure for 2023 is obviously better, but it is the treatment changed slightly. So the next item down, the 5.6 million, that actually relates to some of the things we had to do before we disposed of lionfish. And those are costs related with us preparing for the disposal of lionfish. The next big one-off cost there is we've got $2 million of costs that related to liabilities that came through from previous management. There were some employment tribunals. There was the cost of settling with previous management. There were some advisory fees for work that they'd undertaken that was no longer continued. Again, all of the things that I've mentioned so far impacted 2023 and 2022, but are not part of the group going forward and will not be repeated. The last big one was the $1 million of trade receivables. When we looked at our accounting policy in relation to debtors and how long we would try to pursue them before we actually took a provision against them, we found that we thought we should be more prudent with that. And so we took an additional $1 million of provision in 2023 in relation to those. Now, the policy will continue with us going forward, so we don't see that being a repeat. But in total, in 2023, you've got $10.6 million of non-underlying costs that we had to absorb Again, as I mentioned, the vast majority was non-cash, but it didn't impacted the P&L and the balance sheet. The balance sheet as of 31 December 2023, the things that I'd point out that sort of mean the most from an ongoing business is if you look at trade receivables and WIP, they've come down from a total last year, at the end of last year, trade receivables were 10 million, at the end of 22, they were 9.9 million. They came down to 7.9 million. Half of that change actually reflects the additional provision that we took, and the WIP came down from 9.7 to 8 million. That reflects more the fact that we just weren't as busy last year as we wanted to be, and so the WIP drew back a bit. That's probably it for the balance sheet. Divisional snapshot, looking at the two sides of the business. The left-hand side is the legal services side. The right-hand side is professional services. That would have included Lionfish, but actually those have both been disposed of. So what I'd ask you to do is focus on the left-hand side. As I mentioned earlier, 2022 was impacted quite significantly by one specific project. And so you can see you've got the sort of hump in 2022 and things coming back down, both in terms of revenue and contribution in 2023. However, if you take out the impact of that one specific case, what you would find is that the trend lines for both revenue and for contribution are sort of a steady upward trend that is continued through 2023. Now, we expect 2024 to do much the same thing. If you graph those out, the trend line will continue upwards at pretty much the same trajectory. This is the cash bridge for the year, which is too small on the screen for me to read. You've got the opening balance. You've then got, where did we generate cash? We generated a bit of cash from just operations. We then had a big move in net working capital. And that, to a degree, that was us putting as much pressure as we could on the lockup. So the debtor days in the WIP, and we got the benefit of that. We had some historic tax to pay. We have a tiny bit of CapEx. We're not an asset-intensive business. That's principally around laptops and computer equipment. You've got the purchase of intangibles. We had to renew Ian Rosenblatt's restrictive covenant for £2.5 million. That goes from 2023 for 5 years and through 2028. As he is our largest revenue earner and obviously a principal shareholder, having him glued in place and focusing on driving profitable growth in the business, we thought was a good investment from our perspective. We drew down a bit more on our HSBC facility. I'll come back to that a little later. We had a couple loan repayments. There were some litigation investments we had to make before we disposed of Lionfish. And then we had interest payments and lease payments, which obviously are quite a substantial cost for us. We also had the final payment against the 2022 dividend, and that was made about 2 or 3 months before we decided to suspend the dividend policy. So again, what do we talk about amongst ourselves and at board level as to where we're going to spend our time and energy in 2024? And these are the 5 big areas: reducing risk, increasing the stability of the business, focus on profitability, prudent financial management, and improved operational management. And we'll take each of those one at a time. So reducing risk. Again, that started with the disposal of Lionfish in July. Litigation finance is an interesting business if you have a substantial balance sheet and you have dozens and dozens of cases. We didn't have those. It didn't make sense. It provided too much instability for us, and so it was sold. We also stated we're stepping back from the alternative billing arrangements, which were the CFAs and the DBAs that I mentioned earlier. We may take those on in the future, but we're only going to do it if someone else is funding it, and we are not going to do it at any sort of a similar scale as we have historically. So to give you some numbers, we have a couple of those in our portfolio right now, but the scale of them is under a couple £100,000, whereas the two large cases that we wrote off last year, there was a combined spending in excess of £11 million on those. We're just not going to do cases of that sort of scale. It's not appropriate for a business this size. And again, I mentioned earlier, one of the things when we got into the audit with the accountants was that some of the litigation assets had been inappropriately treated from an accounting perspective in previous years. And we've had to go back and restate that. That led to a number of restatements of the balance sheet at the end of 22 and contributed to some of the write-off in 2023.
We also wanted to increase the stability within the business. Now, Kevin wouldn't want to talk about himself, so I'm going to do it. But when Suzanne chose not to return from her sabbatical, Kevin agreed to stay on. And we're very pleased that he did, because he was instrumental in the renewal of the HSBC banking facility towards the back end of last year. We have a slide on that in a few slides of time, telling you more about the terms. I would say here, HSBC were very good and very good to work with, and we thank them for their continued support. And finally, as part of the strategic review that the management team undertook, excuse me, across probably the first half of last year, really, it was the decision that Convex really didn't belong within our group anymore. Once we divested Lionfish and clearly made the decision to expand and grow and look to invest solely in legal services, Convex was a bit of an outlier. The other thing about Convex is it's a completely binary business. So they are advising, they're trying to maximize revenue and value to entrepreneurs who choose to sell their business. But their fees are 100% conditional. So they could be very, very good at their job. They could work incredibly hard and very diligently for 6, 9, 12 months on a transaction, only for somebody else outside of their control to get cold feet at the 11th hour, choose not to sell their business, or the buyer would choose not to proceed, and it all falls over or gets kicked down the road. And therefore, you don't recognise the fees. When the M&A market is buoyant, you can probably ride those issues. The M&A market is not buoyant at the moment. Whilst it is there, it's certainly not like it was a few years ago. And if you reflect and look at any of the RNS announcements that we've put out over the past year, there was always a kind of caveat around, well, the group will do X if Convex do Y, because there were these deals. So the decision was made to sell it, which we did as part of a management buyout. 2 million to start with, and then there are 4 specific transactions where we have a potential uptick of another 600,000. The first one of those is completed, we've been paid. Second one we believe completes either this week or next week. The third one we're expecting by the end of May, and the fourth one is later in the year. So hopefully see most of that revenue in the next few weeks or month or so. And finally, we wish the new management team at Convex well in their new venture. We also want to focus on profitability. The age-old adage that turnover is vanity and profit is sanity. And yes, we want to grow, and I'm greedy. I want both. I want both the revenue and I want the profit that comes with it. But one of the things that sets us apart from our other law firm listed peers is always the quality and the high caliber work that we've done. It's high margin, in active markets, etc. We'll talk about the new partners a little bit more later, and I can see already there's a question coming about them. But recruiting those 7 new partners has been fantastic, and as part of the work that Ian did with the board around strategy, there are some new areas as well as complementary areas, namely international arbitration. We've got a growing insolvency side, and that's been That's been great to see them come in and sit and sort of complement the areas that we had. Obviously, my first slide mentioned a background in industry, and one of the challenges for somebody like me here is you don't necessarily understand the nuances of the law, which is where Ian and Nick and Tanya have been able to help in terms of getting complementary areas into our business. And a big piece of that now will be improving the cross-selling that we can do. Back in my old life, we would talk about share of wallet, and we still have clients where we do real estate work for them, but not their corporate work, or we do their disputes, but not their real estate. So ideally, sort of, maximising the value we can see and give to all of our clients is primary for the next few months and years. And the final piece of the jigsaw is around our partners and our partner remuneration. We are not an equity partnership. We are not an LLP. We are a limited company that's owned by a PLC. So we're all effectively employees governed by employment law. So last year we introduced a new incentive scheme for partners. We obviously need to pay a commensurate salary to attract and retain the best people that we can. But there's a key element here is that partners can earn depending on the work that they bring in and that they can do off their desk. But the profitability piece, which has never really been looked at before, where they will really earn well is if their work is profitable.
Yep. So prudent financial management, as we mentioned earlier, we announced the suspension of the dividend policy midsummer. That was what we thought was a sensible thing to do, and when we spoke with our major shareholders, they all agreed. Focusing on getting the debt down is a bigger priority. We also commenced a root and branch view of the accounting policies and the balance sheet. Up until last May, as it were, following the acquisition of Memory Crystal, we were operating two legacy systems for the two sides of legal services, and they didn't speak to one another very well. So the accounting processes and the accounting function was very clunky, it was very manual. Once we got both sides of the business onto a single platform, then we had the ability to go and look with much greater detail at the historic records and the items on the balance sheet. And that led us to make a number of decisions around estimates and accounting policies that led to some of the impacts on the P&L this year. We've now concluded that we're comfortable with the policies that we have in place and how we develop our estimates. And in terms of the historic exceptional liabilities that we inherited, those have now all been paid down, and we can look forward with a much cleaner table in front of us. Again, we mentioned the properties. We've appointed 2 real estate agents to reduce our property footprint. Obviously, it's a challenging market, so we're not assuming anything is going to happen very quickly. But over the course of the next year or so, we would hope to reduce property costs by $1 million to possibly as much as $2 million. It just depends on how the opportunities arise for us.
I thought Kevin was going to steal my thunder there, talking about the new system that we have. So in terms of the improved operational management, we had a new system come in last May. As Kevin said, up until then, 2 old legacy systems were in place. They were very old, they were unsupported, neither of them were really fit for purpose. And there were a few sort of stumblings along the way, which is why it took us so long to get a system. It's called Peppermint. And across the board, it means everyone can see what everyone is doing, everyone is on the same system, everyone can see all of the relevant documents. Pretty basic stuff really, but things that we didn't have before. It gives far more sort of improved transparency. That cross-selling piece I was talking about a few slides ago, it really gives an opportunity to maximise and enhance that. However, we feel we're barely at first base really on Peppermint. Yes, it's good. Throughout last year, we spent quite a bit of time integrating probably a very well-known and very well-loved time recording system within the legal profession called Carpe Diem. And we also bolted on an iManage document management system as well. But really, in terms of its reporting, its functionality, its opportunity for dashboards, just day-to-day low-level management in terms of prompts and the cascading of information, and also our fee earners being able to see what's going on anything that they may be working on at any particular time. Really, there's a long way to go yet. So we're quite actually, much as it's frustrating that it's taken so long, it's also quite exciting because we can see the opportunities and the improvements that it will bring.
So we've mentioned the HSBC facilities a number of times. Just to give you a bit more detail on that, we went out for a full re-tender starting at the end of summer last year, and went and presented to more than a dozen potential funders, a combination of high street banks or commercial banks and some of the credit funds that have developed over the last several years. We've had the HSBC facilities in place for the better part of 5 years now. Initially, there was a revolving credit facility, effectively an overdraft, and then there was a senior facility put in place at the time of some of the acquisitions. What we found when we were out there talking to the market is that it is a very, very different debt market than it was 2 years ago, 3 years ago, 4 years ago. Interest rates have come up, and the risk is being priced much more aggressively in the market than it has previously. We had some proposals to take out HSBC, but none of them really worked for us and didn't really work for HSBC. And as John said, to give HSBC their due, they were very commercial, very supportive, and engaged really productively with us, and came back to us with a proposal that we thought worked for us and will give us the time we need to go and reduce our debt. So the extension is for 2 years through the end of December 2025. They kept the interest rate as it was in our previous facility. So that's SONIA plus a margin, which is currently at 3.15%. If we reduce some of the debt, that margin will reduce as well. But currently that means we're paying 8.3%, whereas a lot of the pricing we were seeing out in the market was low to mid-teens. So a vastly different profile in terms of the cost of that debt. The interest payments were effectively suspended until the 30th of June, so we will make our first interest payment in 2024 at the end of June. They put in a schedule of progressive principal repayments that are based on our performance and our cash balances. So it's very supportive in the sense that it says, if you've been profitable and you've generated sufficient cash, then you need to start making those payments. And then there's a bullet repayment at the end. In terms of covenants, they've put a new set of covenants in place that are significantly less onerous than we were seeing out in the market and appropriate for the business going forward.
Thanks, Kevin. Okay, so the outlook from here. Well, without the risk of sort of repeating ourselves, the focus remains on profitable growth. It was our focus last year, and we weren't able to get there. So we double down, we go again, and we very much focus on that growth. So we've recruited some partners now that they're now bedding in, and huge encouragement so far. I'm going to expand a little bit on our partners when I answer one of the questions that's come into the chat. But going back to my very first slide where I talk about a background outside of the legal profession and a focus on good business acumen and ethics and KPIs, we will reduce costs where we can within the business that are appropriate. That will help us improve our margins. It will help us therefore improve our profits. If we can do both at the same time, you get one going down, one going up. That's the kind of holy grail that we're striving for. We are, without any apology for repeating ourselves, cash generation is key. Our shareholders, institutional shareholders, feedback on any of the forums that you may glance at is that the debt is too high. People would like to see it come down. We would like to see it come down. But we are far more confident than we were this time last year that we actually are now in a position to return to that profitable growth and also that generation of cash flow. In terms of the immediate aspirations, I want Q1 to continue into Q2, 3 and 4. In fact, I want it to get better because I said before I'm greedy, I want both. But Q1 has been encouraging, and legal services is doing what we would like it to do and expect it to do throughout January, February and March. We want to retain and recruit the best people. Obviously, those 7 new partners coming in. But when we talk about the 7 new partners coming in, what we've omitted, and we shouldn't have omitted it, but what we've omitted to talk about is actually the 3 partners that we've promoted internally. One of the great advantages of being a limited company and not LLP, as I said, is not diluting any of that equity. So promoting, investing in the staff that we have already, seeing them grow, seeing their business plans develop, seeing their practices grow is some of the most rewarding stuff that we've seen over the last year. By getting everyone together, by getting everyone in more, we can focus on that cross-selling piece. If all those pieces of the jigsaw fall into place, our debt will come down, and ideally, at some point in the future, we aspire to returning to pay a dividend. We're a people business. And how do we retain our people? We retain our people through our culture. Yes, they all like to come to work and they all like to get paid, as we all do. But just a final slide around some of the sort of corporate social responsibilities that we have. One thing I have noticed acutely since coming to work in professional services is, and I don't know whether this is nationwide or just linked to the 2 sort of areas that I've been in, but people here are far more interested in their employer being morally aligned with themselves. It's very, very important to them. And I think we do a lot of that. I'm extremely proud of out of 180 employees, over 50 are full-time members of our ED&I committee. We have a charity of the year that we nominate each year. The staff votes on it from a shortlist of 3. Last year, it was Keen London, which is a charity that looks after disadvantaged children, gives their parents a break. We raised through a series of sort of staff events, etc. We raised almost £36,000 for them. We try and focus on local charities that we can help and see and potentially visit. This year, we're sponsoring Noah's Ark, which is a children's hospice in North London. Again, our internal target is to beat £36,000. We're growing our involvement with the Black British Initiative, which is around looking at black entrepreneurs. Again, a lot of entrepreneurs with businesses need legal services. So we're delighted to be able to sort of assist and turn up and help lecture and mentor and help their businesses grow. One of my personal favourites is Beyond the Bow, which is where you partner with a particular child at Christmas. Our staff last year donated over 200 presents. So make sure no kid wakes up on Christmas Day and doesn't get anything. Absolutely fantastic charity. And finally, one of the longest standing ones is the Sutton Trust, which is a social mobility charity. One of the things about the law, the legal services, the legal profession is quite often it's very difficult to get into. It probably isn't as diverse as we would like it to be. So the Sutton Trust is a charity that promotes social mobility, and therefore we have cohorts of late teenagers coming in and sitting with us and us showing them what the law is about. So that's a little bit around our culture and around how we sort of look to engage outside of the more hours and pounds, shillings and pence that obsesses myself and Kevin's minds during most of the day. So thank you very much for listening. That's 50 minutes, allows us 10 minutes to look at questions. I'm now going to sort of hand over to back to I think it's Alex, but we have 3 questions there, 2 pre-submitted and 1 that's come in already. So without further ado, I'm going to sort of start from the Start from the top down, which is when, I don't think everyone can see these, so I'll read them out. When, please, are you scheduled to pay the group's interest for the period 1st of Jan to 30th of June 24? It is currently parked, but accruing, shareholders understand. I think, Kevin,
So, yeah, as I mentioned, we haven't had to make any interest payments during the first 6 months, but we will have to make a payment on the 30th of June. It will be approximately slightly more than £1 million.
Okay, thanks, Kevin. Can you disclose anything about the 7 new partners appointed in 2023? Yes, I can. I can tell you that we have a new international arbitration practice, Leo Carpentieri and Sara Paradisi, who have joined and very much hit the ground running. They sit within disputes, but we think arbitration is going to be very much a growing area. Again, a nuance for those of you who aren't necessarily well versed in the law is arbitration is something that's agreed at the start of a contract. That if there is a dispute, it will be done in arbitration. It's generally behind closed doors. There's no appeal process. It can be cheaper. I think that could be a growth area. We employed Ed Baker and Nick Heap into our corporate team for M&A work and also some ECM work. We employed a new employment partner called Bob Cauldron. Welcome, Bob. We started an insolvency practice and growth area with Jeff Roberts. Latterly, or fairly recently, I think actually she started this year. There's a lady called Catherine Hammerson-Jones, and she's in disputes. And the final one, who I can't mention his name, is coming later in the year, is a financial conduct authority and corporate lawyer. And just to give names to the 3 that we promoted internally, we have Sam Silverman, who was promoted in the real estate area, alongside his colleague Tristan Walk, so 2 new real estate partners who we made up internally, and Elizabeth Weeks, who was promoted in the area of disputes. What percentage of revenue is generated by Ian Rosenblatt? Why did he step down from the board? I'll take this one. Ian is our largest shareholder and our largest generator of revenue. He is responsible for around about 25%. Some years a little bit more, some years a little bit less. Probably last year a little bit more. Why did he step down from the board? Well, Ian joined the board in July. He'd been involved previously around looking at the strategic piece. But obviously with Lionfish having been sold, the decision to dispose of Convex, which has gone through, with the facilities renewed, a lot of that sort of strategic piece had been done. He was instrumental with Nick and Tanya. As I mentioned already, I'm not a lawyer. The nuances of the law aren't necessarily my forte, but he was instrumental in the sort of decision to seek out and go for international arbitration and the like, and the extra accretive areas that really do complement our full service offering. So once that was sort of done, really, without meaning to sound selfish, we want Ian, out there bringing in the business that he's so good at doing. So it was agreed that he'd step down and very much focus on that side of the business. Can you talk to staff attrition at RBG? Yes. In 2022, like the rest of professional services, it was a pretty febrile environment. It is nothing like that now. We have 7 new partners externally and 3 new partners internally. We have lost some partners. A couple of whom are regretted over the past sort of 6 months or so. We've lost a few fee earners. Where we can, we look at our utilisation, which Kevin alluded to earlier on being only 70%. We target ourselves on 75%. So we're looking at, mindful of the fact that we don't want to turn into a sweatshop, we look at whether we really do need to replace them, and it's only if we do that we'll go ahead and do that. But we have very few vacancies at the moment. Now, part of that I'd like to think is because of the culture piece and the fact that people identify it's a good place to come and work. I think partly it's reflected by the fact that the market isn't quite so buoyant as it was. How much debt do you expect to repay in 24 and 25, Kevin?
Yeah. So we're forecasting between 2.5 million in 24 and at least another 2 million, hopefully more, but we need to update the forecast as we get closer to the end of this year in 2025. If we find that we're generating more cash, we'll do it more quickly, obviously, because I can see part of one of the follow-on questions is saying that the net debt to EBITDA ratio is very high at the moment. Absolutely, we're acutely aware of that. As I said, if we can get 4, 5, hopefully maybe 6 million off the current borrowing level, that would be a great result. We've looked around at other professional service firms, other law firms, to look at what sort of debt structure they have in place. The vast majority of them will have somewhere between 3 and 4 months worth of revenue as a working capital facility. So for us, for example, that would suggest somewhere between 12 and 15 million, an RCF or an overdraft facility of 12 to 15 million. Now, the reality is that's what we've got, but it's fully drawn. So it's not a working capital facility. It's effectively structural debt. So, having something like that going forward, we're very comfortable with, but it needs to actually work like a working capital facility. So the target is to get rid of as much of the structural debt, the senior debt, as we possibly can during that period.
Okay, I'm conscious of time, and we'll get as many of these in as we can. So are you having to pay up to retain talent at RBGLS? Not necessarily. We pay the going market rate. We try and incentivize people properly and fairly, but I would say that profit piece is key. There's no point just bringing in work and churning it and not making any money from it. We don't want to be busy fools. We want to be, sell high quality, a high margin law. Can you confirm the salary and bonus structure for management and how you are aligned with long-suffering shareholders who've lost over 90% since IPO? My salary, Kevin's salary, the salary of all the board are disclosed in the accounts. So I'm not going to go into that now. What I would say is if you've lost 90% since IPO, it is our overarching and overriding ambition is to restore shareholder value. It is absolutely imperative that we look to restore that. The key component to doing that is reducing that debt. It may give you a small shred of comfort, but recently myself, Kevin, Tanya, Nick, Ian, Marianne have all invested our own money further into the company. Your net debt EBITDA ratio is very high at the moment. What's the realistic target?
Can you go to the next one down?
Sure. Yeah. Do you consider Singer's forecasts for December 24 and 25 to be a stretch to achieve or conservative? For a house broker, they seem to be reluctant to back the recovery story.
I don't think they are reluctant to back the recovery story. What we as a board are acutely aware of is that the last 2 years have been very difficult for shareholders. And promises have been made, and it's not unique to this business. AIM is littered with businesses that overpromised and underdelivered. And the mantra that John and I repeat to ourselves and across the organization is to reverse that and underpromise and overdeliver. And so we've put a set of numbers out there that Singers are comfortable with, that we think are achievable and show the business heading in the right direction. As I mentioned earlier, we are to a large degree dependent on the markets in which we operate. And if those markets start to really motor along, we will be the beneficiaries of that. In the meantime, while they're sort of trundling along, our job is to focus on the areas where we can improve our margins the best and operate as efficiently as we can. And that is what we plan to do.
That's great, John. Kevin, thank you very much for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, John, could I please ask you for a few closing comments to wrap up with?
Yeah, no, thank you very much, Alex. Thank you to those people who dialed in. Thank you for your time. We try and run a very open and transparent organisation. We have Sec Newgate. You can reach out to them if you have questions that haven't been addressed during this meeting, and we'll do our best to answer them in a full and proper and comprehensive way. We're excited about the opportunities we have moving forward, and we hope and believe that in 12 months we'll be sitting here with those graph lines continuing to go upwards. So thank you once again, and have a very good day.
Thank you, John, Kevin, once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of RBG Holdings PLC, we'd like to thank you for attending today's presentation, and good morning to you all.